Another feature we get asked about a lot is the inflation component. Now, if you're familiar with long-term care, you would know that the inflation rider is pretty much inherent in those policies. You have to buy an inflation rider if you're selling to somebody in their 50s or 60s, because they're not going to use this policy until they're in their 80s, hopefully. And that's 25, 30 years of inflation in many cases, and the cost of home care services may skyrocket in the meantime, and they may come back down, and then they may go back up. So it's fundamentally a different conversation than with the DI policy. The DI policy, you're not experiencing any of that inflation growth until a year after the claim begins. So that's really important to understand. You could be paying 15 to 30% more to have this inflation function. That's not going to kick in for another 1 year after the claim begins, if you experience a claim. So that's the thing. It's where could you be putting these premiums instead is a great question that we get all the time. And you could be beefing up the benefit. You could be extending the benefit period. So if there's always a question as to where I can put this money in the DI policy, it's a good idea to consider enriching the benefit in some other way. That said, if you are super young, if you're buying in your 20s, 30s, early 40s, you could be on claim for a long period of time. And this inflation is going to be absolutely paramount if you're trying to keep pace, if your benefits are trying to keep pace with inflation over time, over that 20, 30-year span. So don't just write it off completely. We do have a lot of people buying in their 50s. And so for those folks, I would say probably not worth the risk. If you're buying younger than that, weigh the risk, make sure you're making the right decision for you. But if you're skimping on other parts of the benefit structure, I'd say revisit that too.